Many people believe that the key to lowering your tax bill is some secret tax loophole that only accountants know about. But as a Canadian sole proprietor, it's actually a lot easier than that. Hi. My name is Kat and I'm a chartered professional accountant, on a mission to empower self-employed Canadians to manage their business finances with ease, clarity, and without the high cost of traditional accounting services. Today's video is all about the number one way to reduce your tax bill as a sole proprietor. We'll go over the two main costs that make up your tax bill, the best way to reduce these costs so you end up paying less taxes, 3 simple steps to actually get it done. At the end of the video, I'll share a tool I created that's designed to make this super simple for you. So let's jump right in. Before we dive into how to reduce your tax bill, it helps to understand what it's actually made up of to begin with. As a sole proprietor, there are 2 main components to your bill: income taxes and CPP contributions. Both of these are based on the same thing, your net business income. That's your revenue minus your expenses, also known as your profit. Let's look at an example. Let's say you earned $50,000 from your business activities and spent $20,000 on expenses. Your net business income would be $30,000. If we plug that number into a free online tax calculator, we see that you would owe about $1,500 in federal taxes, plus over $3,100 in CPP contributions, plus provincial taxes on top of that. Now let's say you realized you actually have $25,000 in expenses, instead of just $20,000. Your profit would drop to $25,000, and your new tax balance would be about $900 in federal taxes and $2,500 in CPP contributions. That's a savings of over $1,200, without even factoring in provincial taxes. This is why the number one way to reduce your tax bill as a sole proprietor is to track your expenses. As we saw, the more legitimate expenses you claim, the lower your profit and therefore, the lower your tax bill. The problem I see all the time is sole proprietors do spend money on business expenses. They just forget to track them. When tax season rolls around, they can't remember or find all those transactions, which means they end up paying taxes on income they didn't actually keep. So, how do you make sure you're not leaving money on the table? Let's go over 3 simple steps to help you stay on top of your expenses and never miss a deduction again. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Step 1. Know what you're allowed to claim. This is where it all starts. Before you can track your expenses, you need to know what the CRA actually considers to be a deductible business expense. As a general rule, any expense incurred to earn business income is at least partially deductible. The CRA has a whole list of business expenses on its website. I'll put the link in the description box below. But the tool I'll be sharing at the end makes this step even simpler because the list of deductible expenses is actually built in. Step 2. Track expenses year-round. As I mentioned earlier, expenses often get missed because sole proprietors wait until tax season and scramble to try to find them all. And by then, it's usually too late to track things you might not have thought of, like motor vehicle expenses if you use your car for business. The easiest, most efficient way is to simply track your expenses as you go. Set aside a few minutes each week or each month to log all your transactions. This ensures you don't forget anything and saves you from the year-end chaos of trying to catch up all at once. Step 3. Keep receipts and proof of payment. If the CRA ever comes knocking, you'll need to be able to back up the expenses you claimed with both the corresponding receipt, as well as proof that you actually paid for it. Just one or the other on its own isn't enough. If you can't back up the amounts, they could be disallowed. I like to keep electronic copies of all my receipts and bank statements, with backups on USB keys. As long as you have a system that works for you, that's what counts. Okay, now let's get to that tool I've been referring to. I designed it specifically for Canadian sole proprietors with 2 main goals in mind. 1. Reduce your tax bill. 2. Make tax season easy. It's also what I personally use in my own business to track my expenses. The tool itself is a business expense tracker, with automatic totals by CRA categories that match your tax return. It includes a built-in CRA category guide with short descriptions and examples to help you classify your expenses correctly. All you need to do is fill in the tracker with your purchase information like the date, amount, and vendor. Then, just pick a category from the drop-down menu. At the end of the year, the totals are ready to plug into your tax return. You can also send the file to your accountant if you don't do your own taxes. If this sounds like a tool you could use in your own business, you'll find the link to grab your copy in the description box below. Alright, let's recap. 1. Your tax bill is made up of income taxes and CPP contributions. 2. Both of these are based on your net business income, which means the more expenses you claim, the less taxes you pay. 3. The key is to track your expenses year-round so you never miss a deduction. And if you want an easy way to do that, check out the Sole Proprietor expense trackers linked below. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.